Hey everybody, good afternoon. Marty Mazur, August 15, 2016. This will be your one and only video for the week. After tomorrow, I'm going to be gone until the first of next week. I talked a little bit about that in my weekly update, which I just sent you. Read through that if you have a minute, or go ahead and skip to the last paragraph if you like, just to see a synopsis. What I did is the same thing I did at the end of July and just kind of brought you up to date for the month in terms of the data that I've collected in my August current trends file. And essentially what I do is I don't give you all the junk that's in that file, but just the title of each entry. And in many of those instances, I actually tell you what I think about the data that's in there to just kind of get a feel for what's going on. This, as well as tracking all the economic indicators and the variety of things I do on a daily basis. I think it's a good idea to share it with you because it gives you a feel for why I say what I say on these commentaries. But today I thought just for this video, because I just sent you that, I won't rehash some of the things I said there and just focus on the technicals. And that's the chart you have in front of you as a daily one-year chart for the S&P 500. Now, I introduced you last year to a couple of technical indicators. One of my favorites is the moving average convergence divergence, which is kind of a momentum oscillator. And what you look for is you look for the oscillator to move in the same direction as price, and when it doesn't, it shows a divergence. And the oscillator sometimes gives us a heads up in terms of what the action underneath the surface says about the prospects for the market going forward. Now that's the second panel you see there, and you notice I have a green trend line pointing down while the upper chart, which shows the S&P 500 price, continues to slope higher. So that would be the beginning of a bearish divergence. Now these things don't always work in terms of their indicativeness, if you will, but a lot of times they do. By the way, nothing actionable here for our clients. We are long-term patient investors, but I think it's a good idea for me to kind of give you a heads up from time to time in terms of what the signals may be telling us, so you can kind of prepare yourselves for what the media seems to always exacerbate in terms of what's moving markets. So you have that MACD that's suggesting maybe that there's a little rolling over to happen here. It'd be very, very normal. In fact, it would be very normal to test this purple line, which was last May's all-time high. I suspect that there's a very good chance that when we do test that, it will be support, and you might see something bounce. You might see the market bounce off of that. Notice how I've painted two trend lines here: the very short-term upward slope, and then the support line below. Notice these yellow lines that I've drawn here. For whatever reason, and for technical reasons, traders reacting to prices at these round numbers that end in 0, 0, the market has kind of had a fit with these the last few years. In fact, let me just run back. Let's just do 3 years, and you'll see what I mean. So at 1800, 1900, 2000, 2100, and 2200 perhaps. We haven't gotten there yet. But notice as the market came up into this range, it hit that 1800, tried to get above it, and then we had somewhat of a sell-off here, got above it for a little ways, then gave up the ghost again, then finally pierced it to the upside with some force, came back, almost tested it here, and then 1900 became resistance, hit it 3 or 4 times, came through it, but came down, tested it, came up to 2000, couldn't penetrate 2000 really for any sustainable period of time, and then just came careening lower all the way down through that 1900, although that offered no resistance to the upside, came back, and so on. Then the 2000 was support, as you can see, but then the 2100 became a firm line of resistance for quite some time before the market gave up the ghost, played around with these other even numbers that end in 00, hit it again, couldn't pierce that 2100, hit it again and again and again. So 2100 was just a very serious level of resistance for the market. Then we came up against it. As I was telling you up in here, it wouldn't surprise me to see that 2100 tested again. And if we don't hold this all-time high when the market ultimately tests that, if it does, then 2100 is going to be something technicians pay very close attention to. And folks, this is just traders that follow the charts and technicals reacting to various levels. You have a situation where We finally broke above that. Believe me, with all of this resistance, there was a great deal of skepticism, which I talked about. You can see it in many of the indicators about the market sustaining that 2100. If it comes back down, it would make sense to me that these folks who didn't catch it here may want to jump in, provided there's not some exogenous information that has them concerned for other reasons. Ironically, this upward sloping wedge comes right together at 2200, believe it or not. So that's where these two lines intersect. And that would make sense to me that maybe the market struggles with that. Maybe, maybe not. Time will tell. So folks, I just want to kind of give you a heads up that the technicals are telling me that we may have some weakness ahead. If it doesn't happen here, believe me, corrections will come. Sometimes they're single digit, sometimes they're double digit. There's no avoiding them. In my view, smart investors don't time them. They remain patient and so on. We could talk about breadth. The advanced decline line still looks okay. But the number of companies that are trading above their 50-day moving average in the S&P 500, that number is actually rolling over. Not that's a good number of the companies, 3/4, in fact, trading above their 50-day moving average. But what I'm speaking to is actually the trend. As you can see, the trend was moving up, and it's rolled over to some degree. I don't take this as a serious bearish divergence, but it is one of the things that I look at to give me some indication of maybe where the pressure may be in the near term, whether it's more to the upside or to the downside. And the technicals now, for the first time in a few weeks, are actually telling me that maybe this nice extended rally is about to give up some steam. And then we get to a discussion about testing those support levels when we talk about technicals. I'll say it again, folks, this is not actionable stuff for you and me. This is just me helping you put the short term in perspective, which I think is important, and that's the feedback I'm getting from many of you. So I'll leave this one here today. While I'm away, if something crazy happens in the markets and I think you need a little bit of perspective from me, then I'm sure I'll find an opportunity to pop in. Otherwise, you'll hear from me first part of next week. Thank you, as always, for watching and listening, and I'll talk to you soon. Bye-bye.